I know most of you all do not like higher mortgage rates, but in order for you to afford a home in the next couple of years, mortgage rates have to be 10% or higher. Currently, the average 30-year mortgage fixed rate is around 7.1%. And so housing, even though we're starting to see price declines happening in the housing market, is actually 26% more expensive to own a home right now than it was last year with its higher prices. And so that's what the Fed is trying to do. They're trying to raise interest rates in order for home prices to go down. But the thing is, home prices are very stubborn. First of all, it takes them a while for it to go down. Last recession, it took almost 5 years to reach the bottom of home prices in the housing market during that recession. Now, this recession may be a little bit different, but once again, home prices are still taking a while to actually go down. And currently, home prices are still relatively high. When you have this double whammy of higher home prices and higher mortgage rates, it becomes less and less affordable for the common person to buy a home. And in a way, that's what the Fed is wanting. And that's actually what we should want in order for demand to go down and supply to come up in the housing market. Because right now, we still have lower housing supply than usual, but we still have higher demand. And so that's what's really keeping home prices elevated. Yes, you should actually welcome higher interest rates because hopefully that will decrease demand for homes. And on top of that, that'll just bring the prices of homes lower. During the 1980s, we faced a similar situation where the Fed was trying to tame inflation. And so they raised interest rates, and interest rates were going over 15% easily. But similar to what's happening this time around, home prices didn't decrease to the rate that the Fed was actually trying to achieve. Yes, they did tame inflation, but home prices were still relatively about the same. Maybe it did dip like maybe 10% or less, but it wasn't a huge crash like it was in 2008. But hopefully this time around, these higher interest rates do actually affect home prices and they do go lower where it becomes more affordable for most people in the next couple of years. Now, let's drill into some charts, look at some data around income, because income is not increasing at the same rate as everything else is increasing. And let's look at mortgage payments and just the average that people are paying for mortgage payments today compared to last year. Be sure to subscribe to this channel for some awesome content around the economy and the housing market. All right, so just looking at this home mortgage payment graph from Redfin, we see a 28.3% growth year over year. So the average mortgage payment was $2,520 at a 6.65% interest rate, right? That's the lowest interest rate essentially you can get around town, like on February 26th. And if you look at 2022, it was around $1,900, even though home prices were most likely higher last year than they were this year. And so you see over $600 increase in mortgage payment. And so that priced out a lot of people from the housing market. And so that in a way does bring demand down. So hopefully we see more price declines happening in the housing market. And you see that according to Redfin, their home buyer demand index, you're seeing a decrease of 24% in home buying demand happening on the market. And so we are seeing a decline in demand for homes because people are priced out of the market, right? Because of interest rates. They just cannot afford the payments currently. All right, and by the way, this actually started back in 2022. 1 in 5 homes for sale in 2022 was affordable. And so that was interesting because in 2022, we had half of the year where interest rates were low and then half of the year where interest rates were high. You're seeing this unaffordability issue happening because number one, home prices were high. And then number two, we had higher interest rates. And so you see, it was almost half less affordable than it was affordable. So 1 in 5 homes compared to 2 in 5 homes in 2021 were affordable. And once again, you have this affordability. Home listings fell 53% in 2022, and that's going to continue happening in 2023. All right, just looking at the 30-year fixed rate mortgage average in the United States, you see back in 2020 when they started to go down just to fix the pandemic and whatnot, and you see right here it's at a higher number at 6.65%. 1.65%, and it reaches peak in October and November. And if we go even further, we look at what happened in 2008, we see right here that interest rates hovered around the same amount, around 6% in 2008, and then it started to decline, I guess, when home prices started to decline even more. And I talked about earlier in this video where interest rates were over 15%. So you see them reaching its peak around 18%. Crazy number. Now let's look at employment cost index, wages and salaries for all civilian workers, according to Fred. And so you see, yes, there's a steady incline in wages and salary, but it's not going up like big spikes like home prices went, right? And so if you look at national home prices, we went from around here in 2011, 2012 to up here, right? We don't have lines like this for our wages happening at all. Yes, we're starting to see declines in the home price index, but once again, like I talked about, home prices and the affordability is not at the same rate as what people are getting paid currently at the moment. Now, I want to go back here and just talk about inventory, because this is interesting, because there's a few different graphs that look like they're saying different things, talking about inventory, but it's actually telling one big story. So one here, so you see that new listings of home are down year over year 20%. And so the less new listings you have, the less inventory you will have, right? And so we actually want more inventory. We want more supply. So home down, right? And so here it's showing a decrease in home listings. So people are not listing their homes on the market as much as they were doing last year. But you look down here, the active listing homes for sale are up 20%. So the homes on the market is actually up 20% compared to last year. People are not putting their homes up on the market as much, but their homes are sitting on the market longer. Active listings, homes for sale, it's down 20%, but once again, homes on the market is up 20%. So that's actually a good sign, showing that we have more of housing going on the market. And then we have 3.5 month supply available on the market. Right now, it's up 1.4% or 1.4 year over year compared to 2022. So that's another good thing, that supply is increasing little by little. But just looking at that new listing graph, that is a concern, because if that stays around negative 20%, we're not going to have the inventory levels that we need in order to sustain the demand that we have in the market. All right, let me know your thoughts on mortgage rates, and should they go over 10% in order for homes to be more affordable for most people, in order to push down home prices? Let me know your thoughts. Be sure to like, comment down below, and subscribe. Talk to y'all later.